Today we're going to have a little fun and talk about seller financing and owner financing. I'm sure at one time or another that all of us have looked for an owner that would sell their property to us with a small down payment, very little qualifying, and let us make monthly payments to the seller. It's always a good way to go, and I still do that today. I'm always looking for the deal. And the deal is so that you can make income. And usually what we're trying to do is to get some kind of passive income that's going to help with our retirement or just our monthly bills. And so I've created this broadcast, and I got the idea from thenotequeen.com. If you would like to go to a very good website and look that over. And I also picked up some of these ideas from the exchange meetings I go to in Las Vegas. And I go to those 4 times a year, and we buy, sell, and trade real estate. So it's a very fun thing to do. So let's start the broadcast. And so when I'm in Vegas, we buy, sell, and trade property 4 times a year. And it's a lot of fun to see the deals and see how they're structured. And I picked up this idea and part of this idea from one of the meetings. And if you look at the screen, you'll see that I've got a pile of cash over there. And if you look at your $1 bill, it says that this note, calls it a note, is let's see. It says, it calls it a note. This note is legal tender for all debts, public and private. And so that is a promissory note. And we don't think about cash as being a promissory note, but it's backed by the U.S. government. It used to be backed by the gold standard, and it's not that anymore. It's the integrity of the United States government. And your credit card down there, it is a promissory note. In other words, the credit card company will loan the money to pay for the goods that you buy and you promise to pay. Your check is a promissory note, and it's backed by the strength of your banking account. And so when you have an account at the bank and you sign a check, that check is a promise to pay, and they will withdraw the funds out of your account. In the upper left-hand corner, you'll see also a promise to pay, and that's a promissory note. And usually promissory notes are secured by deeds of trust. And the deed of trust is security that you will make the payments. The security is the house or the building that you have sold. And so if the person you sold it to doesn't make the payments, you can start a foreclosure action and get the property back. And there's other remedies also, but we won't talk about any of those because today we're just talking about this relationship between property and paper and how to make it work. And you'd be surprised that the process that an owner uses is exactly the same process that the bank uses. Exact meaning the note and the deed of trust and creating the process whereby the buyer can buy the property. And that process is that you'll see on the screen that you bring the down payment and the bank is up there in the upper left-hand corner and they rent you the money. And they rent the money out for an interest rate, and the interest rate's usually on the note. And it could be anywhere from 0% to 10% or 12 or 15. So I'm going to start that part over. So you take your down payment, you go to the bank and you qualify for the loan, and the lender will rent you the money at whatever the going rate is. It could be anywhere from 0% down payment. So I'm going to start that over. So you take your down payment and you go to the bank and you apply for the loan. And if you're approved for the loan, they'll take that down payment, which could be anywhere from 0% down to 3%, 4, 5, 10, whatever. And so you use your down payment. They will loan you the money at a stated rate. That rate could be anywhere from 3% to 8 or 9% or 12%. It depends on what type of lender that you're using. And then you will sign a note, promissory note, I promise to pay, and they will record the deed of trust at the local courthouse. And then the cash that you difference between your down payment and the purchase price will go to the seller, and the seller will get his money. And so you've got skin in the game, and the bank becomes your major partner. And that major partner wants to be paid back. And of course, this is the thing that we all do. We all use this method, and this is cash to loan. And it's probably the most popular method out there, cash to loan, cash to a new loan. In other words, you're bringing the cash you have, the seller is your the banker is your partner, and they're putting the cash together to help you buy the property. So why don't you search for an owner, and the owner is the one that's going to be the bank? Same process. You see, you take your down payment to the owner. The owner will qualify you. If you qualify to the owner will have you sign a promissory note and a deed of trust. You will get the deed to the property, and the owner will have his security is the property, and you will start making monthly payments. So that's called owner financing or seller financing, and it's a very popular method of financing property. And so owner financing, seller financing is usually easier for both parties because you don't usually qualify as much. There's not so much regulatory paperwork that you need to sign, but you still have to comply with rules and regulations of your state. Now, if you're selling to an owner-occupant, you have one set of rules, and that follows the Dodd-Frank guidelines, and you need to be very aware of those. And if you're selling to an owner-occupant, you would need to have an attorney involved, and the property could be exempt from Dodd-Frank, but you need to have advice on how to do that. If you're selling to an investor, you don't have to comply a whole lot with Dodd-Frank because it's a different set of rules. And you're selling investment property, or you're selling your property to an investor. The investor is buying the property to make a rate of return. But the process is the same, and that's what we're talking about today is the process. And you have to do your due diligence no matter what, whether you're a bank or an owner or a buyer. You want to do your due diligence. So you can see the process where it's exactly the same. The owner or the private lender is going to qualify. You're going to give your down payment to that person. You're going to sign a note and a deed of trust. If you're the buyer, you'll get a deed to the property, and the owner gets the note and the deed of trust. And now they're the note holder, and the note holder receives the monthly payments. Now, I get the argument all the time from people that say, oh, I don't want to finance a property for 20 or 30 years. I don't want to go even 10 years. I just want to get my money and move on down the road. And that's very understandable. But for those people that would like to have a monthly income stream that has a property that they don't have much debt on, or that's free and clear, and you want to seller finance it or owner finance it, it's a very good way to go because you're going to make a greater rate of return than you're going to make at a lender or an institution or banks or CDs. And you'll have a lot of flexibility with that note. So what can you do with that note? Well, you could sell the note for cash. That's not a very hard thing to do. And banks buy notes. Depending on how it's set up and how the structure of the note is, the collateral, the borrower, many things like that, they're going to do due diligence. But you can sell that note for cash, and you may have to take a discount on that note because the investor that's buying the note may say, well, 4% is too low. My rate is 6% or 7 or 8%. And so you have to discount the note so that the investor gets their rate of return. If you just needed a little bit of cash, say you wanted to go buy a new pickup truck and you wanted to pay cash, you could, if you wanted to. That's kind of a hard way to do it. Sell a partial. You could sell 5 years worth of payments. Same process. The investor wants a rate of return that they're comfortable with, and you would assign those 5 years worth of payments to that investor. And at the end of the 5-year term, you would get the promissory note back and the payment back. And so you might have another 10, 15 years to go of getting monthly payments. You could use the note as a down payment. So that note has an income stream. It has a value depending on the rate of return that the investor wants. And you could use that note as a down payment as equity to help buy another piece of property, to be a sweetener for other pieces of property. Let's say that you had $10,000 cash down payment and you had a promissory note that was worth $50,000 that was paying $500 a month for 5 years. I mean, that has a value, and that value could be added to your equity, and your equity would help reduce the amount of cash or other financing you would need for the property. So you can sell that note like that. You can pledge that note as collateral. You could go to the bank and borrow money against that note, and the bank would take an assignment of those payments. And you could, it's a process, but you could include that note in a 1031 exchange. And they do that quite often at the trade meetings I go to. Or you could just trade this note. I've got a $50,000 note. I will trade it at a discount or trade it at face value. I will trade it for your car or your pickup or your lot in Lake Havasu. But I would trade that note and that right to receive those monthly payments for your piece of property. Or one thing that I think we're all trying to get to is we might just enjoy the monthly payments. So if you have a property to sell and you could take the monthly payments, you don't need the money to go buy something else. You have paid this property off. You've had it for years. You would like to enjoy an income stream from that piece of property, then seller financing and owner financing may be the way to go for you. It's a good process. It doesn't fit for all folks. It works for the people that can do it. In other words, they've got property that they could use in many different ways. They could sell it and get cash, or they could finance it for you and just receive monthly payments. So if you're an investor and you've got property and you're going to have a big taxable gain, it may be to your benefit to sell that property with owner financing, because then the gain that you make and the depreciation recapture is paid yearly instead of one big lump sum. So there's a whole process to that too. So thanks for watching this broadcast, and I will end the broadcast and hope to see you in the next show. Thanks a lot for watching.